afternoon, everyone, and welcome to our webinar, Local Government Taxes, Budgeting, Forecasting, and Future Trends. I'm Melissa Keene. I'm a Senior Program Manager with the Institute for Local Government, and I will be your host and moderator this afternoon. Here's a quick overview of what we're going to cover on today's webinar. We have some quick welcome and introductions and logistics, and then we're going to hear presentations from our partner at HDL Companies that will cover some forecasting and trends as it relates to sales tax, and some other information for you all. And then we're going to hear a local government perspective from the City of Torrance and the City of Lemon Grove about how to actually put some of this information into application as you guys are going through your budgeting processes. We will have some time for Q&A towards the end of today's webinar, and then we will wrap up and adjourn by 2 p.m. Some quick housekeeping items before we get started. First, you've probably noticed that your line is muted, and you will remain muted for the duration of today's webinar just due to the size of the audience. But that doesn't mean you can't ask us questions. So on the control panel on the right-hand side of your screen, you should see a box that says questions. Feel free at any point in time during the webinar to type in a question into that box, and we'll be monitoring everything. As I mentioned just a second ago, we will have time for Q&A at the end of the webinar. So feel free if you have questions at any point in time to drop those in, and we will keep track of that as we get into the Q&A at the end of the webinar. Some quick information about ILG in case you aren't super familiar with us. We are a statewide nonprofit affiliate of the League of California Cities, the California State Association of Counties, and the California Special Districts Association. So we provide practical and easy to use resources so that local agencies can effectively implement policies on the ground. We do this in a number of areas. We have programs focused on leadership and governance, civics education and workforce, public engagement, and sustainable and resilient communities. And we provide a lot of education and training through webinars such as this, conference sessions, and other in-person and virtual trainings. We also provide technical assistance, capacity building services, and convening for local governments statewide. So if you aren't super familiar with us, definitely encourage you to go on our website, access a lot of our free resources, and see what other trainings and convenings and things like that we have coming up. So I just want to quickly introduce today's presenters. We have Ken Brown, who's a principal with HDL Companies, Nicole Cohn, a vice president at HDL and Cohn & Cohn, Eric Myers, a senior operations manager with HDL Companies, Sheila Pozon, the finance director with the City of Torrance, and Lydia Romero, who's the city manager in the City of Lemon Grove. So first up, I'm going to kick it over to Ken to talk about local tax revenue. Ken?
Great, thank you so much, Melissa. Just first, a real quick note about HDL. On the next slide, we are proud to serve local governments for 39 years. We work with more than 500 municipal clients, including special districts, counties, and cities throughout the state of California and in other states as well. And we are blessed to have a 99% retention rate. In the next slide, real quick, I'll overview the purpose of this presentation is essentially to talk about what HDL sees in terms of various revenue sources, including sales tax, cannabis tax, property tax, and hotel tax, and also to see how these trends are impacting our partner cities and their long-term forecasting. So again, my name is Ken Brown, a principal at HDL Companies. I'm going to be taking the first part of this presentation, which is focusing in on sales tax and cannabis tax trends. So as a way of beginning that conversation, I want to first orient you by providing you with this 3-year comparison. I find this really fascinating. This is a comparison by sales tax major industry group for the last 3 years, calendar year 2019, 20, and 21. So of course, calendar year 2019 was before the COVID-19 pandemic. And so we can see how that compares to now, the year that just recently concluded in December 2021. And so the good news here is that the state is fully recovered. We are up 16% in terms of our sales tax receipts. The major reason for that, most categories are up quite a bit, but the one that's up the most is the county and state pools. And the reason for that is essentially a legislative change that took place in 2019, Wayfair AB 147, and that was the legislation that allowed for the additional taxation, the taxation of additional goods purchased online on the internet that were shipped in from out of state into the state of California. So that helped really to propel the county and state pools since 2019. The one category that is still a little lower than before the pandemic, and this is interesting, is restaurants and hotels, which as for all of calendar year 2021 was down about 6%. So in terms of your agency's recovery from the pandemic, flipping to the next slide, it certainly matters a lot which major industry groups you're focused most heavily in, but it can also matter which part of the state you're in as well. So this is a comparison in terms of an overview of the different regions within California in terms of the recovery since the pandemic. And so it varies considerably. Regions such as the San Joaquin Valley are up about 34% compared to before the pandemic in 2019. But others, such as the Bay Area, are only up 6%. Now, of course, the Bay Area is heavily tourism dominated, a lot of great restaurants there. And so it's also a factor of the major industry groups that each agency is heavy in. But it is interesting to see a comparison between both metrics. Now, as we turn to the next slide, we look at our outlook going forward. And so our team at HDL, when we're looking at our projections and what we think the outlook for the state's going to be, we don't only limit ourselves to looking at recent trends and sales tax performance, but we also look at a number of key economic indicators and events, such as what you see here on the screen. Turning to the next slide, you can see that one of the biggest news stories that you have seen in recent years is inflation. Inflation is now running 8.5% higher than what it was a year ago as of March 2022. So while there are some signs that inflation is beginning to moderate just a little bit, this is the highest rate of price increases we've been seeing in 40 years. And so this is really an interesting phenomenon because strong consumer demand on the next slide after the pandemic is lifting inflation, but supply chain shortages, for example, what we saw with computer chips, is limiting inventory and supply for things like automobiles, and that's further lifting prices. So it's sort of a continuing cycle, and it's also feeding into greater spending and sales tax receipts with more dollars spent. And so that certainly is a major background function of what's happening right now. So I want to turn though now to sort of the global, what's happening globally, and focus in on the major industry groups and sales tax. And unfortunately today, I don't have time to talk about all of them, but what I do have time is to share with you some information about the 4 largest major industry groups that comprise the state sales tax base. And so we'll focus in on that. We'll talk about what we're seeing and also what the outlook is for each. And it's sort of the same story for each. You'll see in just a minute. But these 4 categories comprise about 68% of overall sales tax receipts. Interestingly, on the next slide, the county pools is now the largest statewide sales tax category for the first time for the state of California overall. So this was, typically in the past, second, third, fourth, it's now risen all the way up to be number 1 this last quarter. And so you can see that was due thanks in large part to considerable growth back in 2019, 2020. So I already mentioned the Wayfair AB 147 legislative change, and that certainly contributed a great deal to the growth that we see there in the middle of the graph there, peaking at about 41.8% in the third quarter of 2020 for the county pools. But certainly another factor that also played into this was the pandemic. So a lot of folks chose to shop online during the pandemic, either because they had to, because their local stores were closed, or because they felt safer doing so, more comfortable doing so at a time when there was a lot of fear about infection from COVID. And so interestingly, I think what you'll see, the big takeaway from this graph is you see that tremendous growth up into about 3Q20, at which point the growth begins to decelerate up until the most recent quarter on the far right of the graph. You see that actually growth went slightly negative back in 4Q21, down 2.2%. So this is a pretty substantial change from what we have been seeing. Turning to the next slide, we look at the different categories that make up the county pools. And interestingly, the one that's circled there, general consumer goods, is the one category that is lower compared to 4Q20 in the most recent quarter. And so a big reason for that is folks were happy to be out shopping again when they could, when sort of the pandemic is in the rear view mirror. So a lot of folks were happy and anxious to get out and live their lives again and be out and shop in stores once again. And so turning to the next slide, you will see sort of what the history's been and also our projection for what is now the largest statewide sales tax category, the county pools. And so here you see that same 42% growth, close to 42% in 3Q20, slowly decelerating. And so we do expect this category, the largest category, to plateau significantly, still positive, but rates of growth looking forward more to be like 3 to 4% per quarter instead of 20, 30, 40%. And so this is expected in large part because consumers are returning to brick and mortar stores. The other factor, though, is that during the pandemic, spending on travel and other services was severely curtailed. And so we do expect that there'll be sort of a switch back towards spending on travel and other non-taxable goods. Another factor that has hurt the pools on the next slide is a major structural shift for a large taxpayer, that's statewide taxpayer, that's had a pretty dramatic impact on shifting tax allocations between the pools and to the business and industrial category. And so what you see here is you see the pools in a green line, and you see the business and industrial category in the orange line. So what happened is that essentially this major taxpayer shifted their operations so that tax receipts that previously, up till about 2020, went to the pools. Many of those allocations for that entity are now going to the business and industrial category. And so you can see the green line over the last year sort of leveling off just a little bit, and the orange line sharply accelerating. So that certainly is part of the story. And focusing in, it's going into the fulfillment center category on the next slide. And so on the next slide, you can see dramatic increases, particularly over the last year, in revenue from fulfillment centers. And so this money is really shifting out of the pools, and it's going to a small number of cities throughout the state that is dramatically increasing their business industrial fulfillment center revenues. So that's certainly another important trend. And that's playing out into our forecast for the business and industrial category, which is also one of the largest statewide sales tax categories. On the next slide, you can see a line graph that shows what we've seen, what we've been through with the business and industrial category. And you can see recently growth has been in like the 20% range, particularly in the last year as this significant tax shift occurred. But going forward, we're sort of past that in terms of the year-over-year comparisons. And so we're still projecting positive growth, but just like with the pools, we're projecting a slower, a deceleration rate of growth. And also with COVID-19 outbreaks overseas hurting our supply chains, US factory activity is slowing, but it is still growing, as exemplified by the ISM index, that's the manufacturing index, recent reading at about 55.4%. Anything above 50% is an expansion territory. So our outlook is still for growth, but just a lower rate of growth, similar to what we saw with the pools. So you're getting a theme here. Turning towards general consumer goods, quickly, I want to share this on the next slide, a graph with you. We update this every year. It's a fascinating graph. Brick and mortar store sales, the green line up top. This is tax receipts from traditional retailers. Down below, you can see online sales in the light blue. Every year, these two lines have been growing closer and closer and closer together. But I think the interesting thing is that in the most recent year, sort of what I was talking about previously, is that after COVID, folks appear to be in a shopping mood and a get out of the house mood. And so you can see actually sort of a reversal of that long-term trend we've seen for so long, where for at least a temporary time now, brick and mortar store sales are actually accelerating. So that's really interesting to see. And so that plays into our forecast on the next page. However, we do expect, just like you saw with the pools and business and industrial receipts, we expect the same flattening rate of growth. So coming out of the pandemic, we just saw absurd rates of growth from an albeit depressed levels last year for general consumer goods, 76.7% in 2Q21, absolutely phenomenal growth. But we expect that to plateau down into the very flat levels. And a couple of the reasons we think that's going to happen. One, inflation is increasing dramatically, as we talked about. So that is resulting in consumers needing to prioritize their spending, to tighten up a little bit. But also, there's also this new competition again for travel and non-taxable services and restaurants as well. And so there's more options for spending right now. And so we think those factors are going to play into, again, for this third category, a slowing in terms of overall tax receipts going forward. Now, the last category I want to talk to you about is probably the most fascinating. This is autos. And this has just been really incredible to watch. This is a graph of auto inventory on US dealer lots. And it goes all the way back to 1994. It's from the St. Louis Fed. And you can see that auto inventories as a ratio of sales are at the lowest levels ever, going back all the way to 1994 on this graph. So what this has done on the next slide is it has resulted in higher prices. And so you can see here that new car pricing is up 11%, thereabouts, on a year-over-year basis. We haven't seen anything like that in terms of this graph going back to 2017. If I had a used car price graph to show you, it would be even more. I think used car pricing is up 30 to 40% year over year. So absolutely insane. I heard a recent story that was really interesting. One of our clients in one of my meetings shared with me a story that she was in the market for a new Ford Bronco. And the sticker price on this Ford Bronco is about $60,000. She was put on a wait list. It was a 14-month wait list, I think she told me, for this car. She finally, after looking around, found a dealership up in Los Angeles that would sell her this Ford Bronco. But when she went to talk to them about the price of the vehicle, they were asking for, if you can believe it, $100,000 for this $60,000 car. So just really incredible things are happening in the auto space right now. If you turn to the next page, you will see in terms of sales, this is again from the St. Louis Fed, nationally, unit volume for car sales is actually lower now than what it was before the pandemic. But in terms of taxable receipts, if you flip to the next page, they are very strong. We had growth in the 46% range year over year in 2Q21. And so actually, even now, with all these inventory challenges and the like, we are at a level of about 24 to 28% higher in terms of taxable receipts than where we were before the pandemic began. And so that's a function of, of course, pricing being higher, but I think it's also a function of folks trading up to more expensive cars than they might normally buy, perhaps with all that equity from the stock market they've realized, with the equity in their homes. Maybe they're trading up to a Mercedes instead of a Camry. So there's a lot of stuff going on there. But again, just like the other categories we talked about, you see here a significant slowing in our anticipated rate of growth. And so we believe that higher financing costs, and the headline news today, just maybe about an hour ago, Federal Reserve increased interest rates about 0.5%. And so that's going to feed into financing costs for homes, for autos, and other consumer purchases. That and also the high price of gas is going to slowly result in a plateauing sales. Particularly, I'm going to be watching RV sales. That's going to be interesting to watch with these high gas prices. So every category here we see is slowing down a little bit. On the next slide, I'd like to get your take. This is really the question. Everything's slowing. Where do we go from here? Do we have a recession? So I've got a question for the group. How many of you think, in terms of a poll, that we're going to have a recession within the next 12 months? So I'll ask for some help getting that poll question there.
Yes, I'm going to go ahead and launch this. You all should see that pop up on your screen, and feel free to respond. And while you're doing that, I just want to share one quick thing that I forgot to mention at the outset is that we will be sharing the slide deck and recording with all of you after the fact. So if you're trying to take notes or pictures of these graphs, rest assured that we will be sharing them with you all as well.
Okay, so leave this just open. Okay.
Sorry, go ahead.
Just leave that open for a minute and we'll get the results.
Yeah, got about 80% of people responded, so I'll give it another few seconds here. Okay, let me go ahead and close this out and then I will share the results. So hopefully you all can see the responses now.
All right, this is a pessimistic group, it looks like today. This is great. We've been hearing a lot of scary headlines, that's for sure. All right, so 51% think there's going to be a recession, 28% no. So if we could turn to the next slide, this is a little bit dated, it's from April, but just as a comparison, compared to about that 51% rate of folks in this call that think we're going to have a recession in the next 12 months, Wall Street Journal does a quarterly survey. In the April survey, about 28% of economists think that there's going to be a recession in the next 12 months. Now, this group is probably smarter than the surveyed economists, so you guys might be right, but we'll have to wait and see. But really what I'm watching, and if you can turn to the next slide, we know one's going to hit us one day. The question is when. And this is probably one of the best indicators that we've got. This is something that is worth watching. This is what we call the yield curve. Yield curve is basically the differential, in this case, between the 10-year Treasury bond and the 2-year Treasury bond. So normally the 10-year Treasury bond yields more than the 2-year Treasury bond. And whenever that happens, you see the line above that dark line in the middle, the zero line. And that's normal state of affairs because people want more for a longer term investment. But from time to time, it what we call inverts, and people are willing to pay more for a shorter term maturity. And when that happens, it goes below the line, and you can see every time that's happened before, there has been a recession after that. And in fact, the data says that since 1900, an inversion of the yield curve has predicted 22 of 28 recessions. So pretty good indicator. And the scary thing is that just recently it did invert again. However, it inverted just for a couple hours, I believe, intraday, and then closed above the line, which is the good news because normally this has more predictive powers when it's inverted for a couple months. And so it was really only inverted for a couple of hours instead. So in terms of another indicator I'm watching, if we flip the page, this is the same sort of comparison, but this instead of a 2-year bond is comparing a 3-month T-bill to that 10-year bond. And in fact, the Federal Reserve Bank of San Francisco and a bunch of other investment firms have said that this is a little better indicator of a potential recession. And you can see here that it is not inverted at all. In fact, it is steeply positive. And so that's the good news. And so, you can see in the past, every time that it did invert, the gray area following that, we did go into a recession. That indicates a recession. So we'll have to see what happens going forward. But I think the important thing to remember is a lot of us have in our minds the scary events of 2007, 2008, when we had that horrible grinding 20% dip in sales tax revenues over 3 years. Could happen, but I think more likely we would have a recession similar to 2001, 2002. And I went back and looked, and believe it or not, at that point in time, sales tax only fell about 2% in 1 year and then fully recovered the next. So it doesn't always have to be a brutal grinding recession like we saw back in 2007, 2008. So turning to the next page to conclude and to summarize, history shows that 11 out of 14 tightening cycles, like we're engaged in right now with the Federal Reserve lifting interest rates again today, half a point, 11 out of 14 cycles in the past were followed by a recession within 2 years. However, it is really hard to find a parallel with today's post-pandemic environment. Usually it's wrong to say that it will be different this time, but it is possible. The chances of a recession are increasing, but consumers are incredibly strong, sitting on a lot of cash. I think if there is to be a recession, it's likely at least a year out. History shows us that when the yield curve inverts, it's usually 2 years and sometimes as long as 3 years before we experience that recession. And I would be hopeful that any recession that we would have would be more like 2001 and 2 and not like 2007 and 8. So our forecast overall, if you can flip to the next page, is for continued expansion in terms of sales tax receipts by year. This forecast goes out 5 years, but a substantial deceleration in growth. So we're looking at 12% rate of return in sales tax receipts this year, but then dipping down to 2 to 3% per year thereafter. So real quickly on cannabis on the next page, I will just point out one of the fascinating things to me on cannabis revenues is that this is the first quarter, 4Q21, where we actually saw cannabis sales plateau after years of incredible growth. So most of the growth that we're seeing now is from new outlets being added. There's a lot of new dispensaries opening up throughout the state even still, but the growth, we're just not seeing it in most existing store sales. And so I think it's a function of competition both from the illegal market that is, doesn't have to deal with the taxes, but also due to what I call the hangover effect after the stress of the pandemic. We saw a lot of spiking receipts from alcohol and cannabis sales during the pandemic, very high receipts in 2020 and 2021. Now they're starting to plateau a little bit in comparison to those elevated levels. I think that's normal and healthy. So with that, I will turn the presentation over to my colleague, Nicole Cohn from our property tax team. Thank you.
Thanks, Ken. I'm going to go over the property tax outlook for 22-23 and beyond. And I always start my presentations with a little education because the timeline sort of doesn't make sense. And so I always want to start with that. So I'm going to go through the timeline for 22-23. The lien date for 22-23 was January 1st, 2022. And as of that date, the assessor is going to apply the CPI per Proposition 13. But the important note is that it uses all events that happened prior to that day. So it means that it's using calendar year 2021 events to inform the 22-23 value. The assessor, takes that role and then takes about 6 months to apply all their changes and close it, and then sends it over to the auditor, who applies their taxing percentages and direct assessments, and needs to get that over to the tax collector to generate bills. Bills are printed and mailed in September, and taxpayers receive those bills and have to pay taxes in 2 installments, November 2022 and February 2023. Revenues are remitted to the tax collector and then back to the auditor for apportionment to all of the agencies. And the apportionments occur between November of 2022 and August of 2023. So what that means is, let's say an event, a large sale of a commercial property in first quarter 2021 doesn't get realized as revenue by your agency until at least November 2022. And so there's this huge lag that is good in some ways because it's very backward looking. But I'll encourage you to keep a hold of this slide. So when your elected council member or board member comes to you and says, I read this article in the paper and I want you to reduce your estimate by something because this is happening, you pull out this and you say, yes, that's happening now, but that's not going to impact us until a year from now or 2 years from now. So it's really important to realize and understand that that's the way it works. Next slide. If you want to do the first polling question, Melissa, might be a good time.
Yeah, sure. We can go ahead and launch that. Okay, hopefully you all saw that pop up on your screen.
So where does your agency get the majority of your information for property tax projections? Do you use a review of historical growth? Do you look at CPI data, consultant projections, none of the above, or you're not sure?
About half of folks have already voted, so just us another few seconds here. Okay, that's almost everybody. So I'm going to go ahead and close this and then share the results.
Okay. All right, so it seems like a majority of you are saying consultant projections. As a consultant, I appreciate that. The historical growth is also interesting. I'm going to sort of walk you through in the next slide the segments that drive growth in property taxes. So because property tax is so backward looking, I have the benefit when I work with clients of really knowing a lot of the events that have already occurred when they're trying to do their projections. So the CPI per Proposition 13 will be 2% for 22-23. The Prop 13 says it can't be more than 2. And the good news is that for 21-22, the CPI was only 1%. So right off the bat, you're already getting about twice as much growth from inflation from the CPI as you did for 21-22. One thing we're really watching very closely is property sales. And I'm sure all of you are aware that single-family median sale price sort of started to increase as soon as the lockdowns lifted. It was sort of flattening in the first quarter of 2020, and then it took off, and it has not stopped since then. Most counties saw double-digit single-family median sale price growth in 2021. We're going to look at a graph by county in a moment. But lost values to be restored under Proposition 8, that's been a segment of growth that we've seen in, say, the last 5 to 10 years. Prop 8 reductions have to do with properties that sold during the last downturn, or right prior to the last downturn, and were reduced by the assessor. And they were reduced as the market rebounded. There's this value pool that's being restored as the rebound is happening. But because the medians have appreciated so much in the last 5 years, there's really not much left in that pool to be recaptured. So whereas in a prior year, you might have seen 0.5% or a percentage growth from that pool of value, it's just not there to generate any significant growth. New construction completions in 2021 need to be considered. So if you have single family, new construction, large commercial projects, hotels that got their certificate of occupancy in 2021, it's not enough for them to have just started building. It needs to be completed prior to the end of 2021. Maybe something should be used for that to be considered, especially if it's a large project. VLF in lieu, for those agencies that are watching that actually receive VLF in lieu, cities and counties, the VLF in lieu increases by the citywide change in value between tax years. And I'm just going to talk about the general fund growth might be, is related to the general fund portions of your city, but the entire city growth is related to the entire city, including successor agency parcels if you have them. So if you have an active and vibrant successor agency that's adding, that portion of the city is adding value and units and commercial, your VLF in lieu could potentially increase by a different percentage than the general fund is growing. Next slide, Melissa, please. So sales are probably the thing I like talking about the most. It's maybe the most interesting segment of what I do. And so right here we have the median sale price year-over-year comparison. So every county in the state, the 2020 median sale price and the 2021 median sale price, and the year-over-year median change. The average and medians are just around 14.5%. 80% of the counties in California saw median sale prices increase more than 10%. The green are increases less than 8%, and the yellow are increases more than 18%. And if you look at the yellow counties, you'll see sort of a trend in a lot of cases towards the eastern portions of the state, the more inland, more affordable counties. That's due to a couple things, that they're adding more units, more single family unit, more building out that way. And when COVID happened, you saw this shift away from the more coastal cities. So more and more people are able to work from home or work from home more days, and so they're maybe more accepting of a longer commute because it's just a couple days a week. So we are seeing that trend. The increases that we're seeing are due to a combination of factors. So you have the low interest rates, people pre-approved, ready to buy, and they're all fighting over the same house, the same limited number of houses that are coming out every weekend. And so that's driving up prices in a way that is, sort of artificial. Increases will be reflected as assessed value growth in 22-23. Again, these are 2021 sales, so they're going to, back to my timeline, they're going to be impacting 22-23 directly. Increased sale prices also are reflected in documentary transfer tax increases and supplemental property tax allocations. Those are both driven off of transfers of ownership. And then sort of something else to be aware of is that the median is important. What happens, what things are selling for is important, but in some ways just as important is how long has that house that's selling been in the same ownership. So Lydia, who's going to talk to you a little bit later, we saw this phenomenon in Lemon Grove when I met with them. And so they have dozens of houses that have been in the same ownership since the late 70s, early 80s, all selling for $600,000, and they have this artificially low assessed value because they've been in ownership for so long and just DPI on them, and so that's adding huge amounts of value to the roll. And so it's related to the median, but it's a little bit more complicated. Most counties have seen prices continue to rise in first quarter. We just got the data through the end of March, 10 days or so ago. Most counties look like 5 to 6% increases over Q4 2021. A couple of them are flat, but for the majority of them, they're still continuing to increase. I attribute that to people trying to get their last minute deals before the interest rates go up. Melissa, maybe the second poll?
Sure, let me get that launched. Okay, you all should see that on your screens now.
I'm just curious how on target your annual property tax forecast is. So is it within 1%, 1 to 2%, 2 to 5, 5% or more, or you're not sure?
I have about 50% responded, so I'll give this a few more seconds. A lot of folks are not sure. That's okay.
I should have told everyone that I was going to ask this.
So let me go ahead and close this, and then I will share the results.
Okay. Yeah, 2 to 5. So 20. The biggest portion, other than not sure, is 2 to 5%. And 1 to 2% is not too far behind, so that's interesting. I'm going to talk about forecasting, beyond 22-23, and some of the sort of mid-year impacts for 22-23. The successful appeals, so that's the only, immediate potential negative thing on the horizon. So you had in 2020, businesses shut down, a lot of businesses closed, and office vacancies. So all of those things have led to a lot more appeals being filed for the 2021 roll, and some, more than usual for the 21-22 as well. So successful appeals that are, reduced mid-year results, they're pooled, and every agency shares in their share of the negativity there. But the interesting thing is that the appeals that have been filed are just not being heard, and I'm going to talk about that a little bit more in the next slide. Supplemental allocations for 22, 23, and beyond are uncertain with the interest rate hikes. So the big question for us, sort of is inflation related as well. As the interest rates increase, how is that going to impact medians? How is that going to impact volume? And what's that going to mean, for our clients going forward? We buy sales data on a monthly basis, so we have a pretty, good idea what's happening. And because of the backward-looking, the timeline, we have some ability to warn people and to have them adjust. But it's a concern for us right now. Will the sales continue throughout 2022, and how will that impact the supplemental allocations, which are pooled mid-year and sort of on a different timeline than the initial one I shared. The CPI increases for 23, 24, and beyond are uncertain. 2% is likely unless we're in a recession. So the CPI under Proposition 13 has been around since 1978. In all those years, it's been less than 2%, just 11 times. So my money's on 2% unless we start to see more indication of a recession. And the CPIs are measured October to October. So the 23-24 CPI is measured October 21 to October 22. So we're already pretty much halfway through that year, and the inflation's off the charts. So I'm going to say 2% is likely, until we start seeing something more concrete on the recession side. Next slide, please. This is a graph of the valuations under appeal. So it shows 1920 appeals, so percentage of total assessed value in each county under appeal compared to 2021. You can see how dramatic that is because of mostly COVID effects. Next slide, please. So those 2021 appeals that were just received for the current roll, those were due this past November. Many are still being processed into their systems, but the 2020-21 appeals that were due the prior November, just about a third of them have been even touched, and most of those, the resolutions to them are mostly administrative, meaning somebody withdrew their appeal, somebody didn't show up for their hearing. They're not being heard and cleared through the assessors and tax or the client clerk of the board's staff. That's not even starting to occur yet. And so, we're waiting for these appeals to start being heard so we can sort of quantify what we think is going to happen on the reduction side. So likely 2 years before appeals are heard in significant numbers. So sometime in 2022, maybe later this year, we'll start seeing some of those 2020 appeals to be heard. And most of these appeals are Prop 8 type, meaning they're reviewed annually. And if the situation that caused them resolves itself, then the value just gets adjusted. A lot of the appeals are office buildings that have vacancy because of remote work, hospitality that was closed for a portion of 2020 because the hotels the shutdown, that's resolved. So a lot of these situations are very temporary and have already sort of righted themselves. We expect no to very limited losses on the appeals side for residential and bedroom communities. They just don't have a lot of exposure except for in the pooled aspect of appeals. So when appeals are heard and reduced mid-year, it results in a pooled reduction that every agency shares. So in conclusion, every city is different, and so it's really hard for me to tell you what's going to happen for you. I think I'm pretty safe in saying any growth you're going to see for 22-23 is going to be more than you had in 21-22, unless you had some big project that came online, because the CPI is double. So you're already sort of starting out at a higher level, and the sales were so robust. And then minimum 2%, and we've done projections for 250 agencies. Very rare to see growth less than 4%. For 22-23 in our projection. So hopefully that's somewhat helpful, even though I can't help all of you individually. So I'm going to turn it over to Eric Myers, who's going to talk about business tax and hotel tax.
Thank you, Nicole. I appreciate it. Just a brief note before I jump in on business license and transient occupancy tax considerations. Excuse me, I apologize for my voice. Um, the data that we'll be looking at is through the December 2021 expiration period for business license, which means, for example, any gross receipts data is backward looking, right? It's the 2021 gross receipts. So it's important to keep in mind because you'll see some interesting trends. I think they're in line with what we've heard, particularly from Ken, about some stalling and a little bit of growth. Another thing to keep in mind, which we'll touch on as we go through each of these sections, is that while I'll be showing you some of the overall trends, there is a large amount of disparity between given cities depending on the makeup of their economy. For example, if you've got a heavily retail economy, you may benefit more from the trends that Ken was mentioning earlier than if you've got perhaps a low wage service sector. And it also depends on the makeup of your business license. So we'll talk a little bit more about that. The first thing to note here under business license is that we're not seeing a strong recovery overall yet. What we've seen is the bleeding has stopped. I think, as we'll point out here in a few minutes, part of what's driving that is a lot of the CPI kickers have not yet picked up the inflation. And will do so here at mid-year when many of the cities have their CPI kick in for business license. And so if we were to look ahead next fall, we will probably see from the fiscal year renewals, we'll probably see this be slightly positive overall, but through December, really a flattening out of the losses and sort of a stabilization. So next slide, please. What we want to focus on here, just very briefly, are the three most common types of business license structures in California. Those are employee-based, flat fee, and gross receipts-based. We'll take you through a little bit of what we're seeing in each of those, and maybe what are some of the considerations you may want to consider when you're looking at your forecast for your city. So to the next slide, what we're going to start with is the employee-based sector. As all of you are aware, we went through this past fall the Great Resignation. We've seen upward prices. There's more demand than supply in terms of employment, especially at the lower wage tiers in the market. And that you can see, if we go to the next slide, please. You can see that that's being reflected through December and what's being reported by cities that have employee-based gross receipts. We've seen overall a net growth of about 9%. So again, that's not the majority of the cities within this data set, but those that are reporting employee-based in December, we are seeing recovery in the number of employees, which is great to see. One of the trends we were seeing originally during the pandemic was really a loss of employees and a consolidation in the market. And so seeing this recovery, I think, is a very interesting trend. So if you have employee-based, looking at your employment levels locally and what kind of structures the employment has. One of the things to be cautious about here, though, is that we are seeing more virtual and work from home. And so as that happens, employee-based is potentially going to run into a dropout, even if there is not a downturn or an uptick, excuse me, in the unemployment rate, right? So you may begin to see a dispersion of employment to residential communities from your office-based structures. All right, so next slide, please. So that, again, when you're forecasting, if you've got an employee-based, it's good to look at overall trends. It's probably better to look at your local employment trends. Look at the structure also of your economy. If, for example, you've got a lot of reliance on professional services, again, we're seeing a lot of those not really returning to office as aggressively as, say, some of the retail businesses. So in certain cases, you're going to be looking at maybe less revenue than your unemployment numbers might indicate to you. And then again, to keep an eye on the impact of market consolidation. We did see some of that in the bottom of that U-shaped curve, where a lot of small businesses kind of closed their doors during the early stages of COVID. And it wasn't so much that there was a decrease in the market that was permanent, it was that the bigger players picked up the demand, particularly those that had some online capabilities. So next slide. Just again, to give you a little bit of context here, this is just looking at the overall employment trends. The red line is the United States, the blue is California. You can see in the pandemic that there was a large spike in the unemployment rate, which has now gone down. However, it is fairly localized. So if we go to the next slide, what we'll see, right, is that it's pretty unevenly distributed. And we've seen, continued lumpiness, both geographically and then within particular industries. So again, it behooves you to pay attention to, as you're working on the forecast, what are our major sectors within our economy, and what are the specific employment rates within those sectors, which we've just briefly put into the next slide. You can take a look at some of the areas where the growth is according to the EDD here. Major employment trends, again, leisure and hospitality topping the chart, just in terms of overall numbers of growth. Growth in professional and business services, but as we mentioned before, be cautious about that when you're forecasting, because a lot of those are working remotely and may not show up within your city. All right, so to the next section. We'll now talk briefly about the flat fees. And those that have flat fees, again, because of the CPI kicker, basically our conclusion on flat fees, it's a little too early to tell from the data. If you want to go ahead and switch to the next slide. What we're seeing with those that have flat fees is that the revenues, at least through December, were down. But again, I don't think this has picked up yet the full impact of the CPI increase. So generally speaking, if you've got flat fees, you should be looking primarily towards your CPI kicker. If you've got a CPI kicker, you should be in okay shape, given what you saw earlier from Ken and the inflation that we're seeing. So that should get picked up fairly easily. If we can go ahead and advance to the next slide. Yeah, so again, just a caution, this is run through December of 2021, just as we were seeing that inflation really take off. So there's a mismatch in timing between when the inflation was taking off and when the CPI is being adjusted. So these numbers right now, I think, are a little bit negative in their skew, and we should see corrections as we come into the fiscal year reporting cycle. Next slide, please. And then again, as noted, market consolidation, so a decrease in the number of businesses or an increase in the number of closures is a key factor when you're looking at forecasting here, as well as potentially looking at the size and rate of your CPI kicker. Does it have a cap? When does it kick in, et cetera? Next slide, please. Okay, so the final area on business license that we'll talk about is gross receipts based business licenses. This is interesting because it has a tighter correlation to some of the economic activity that may be happening within your cities. If we can go ahead to the next slide, what we'll see here is a growth rate that's a little bit more positive. We're seeing about a 5% increase over 2021, which would have actually been 2020. So we are seeing, again, not huge amounts of recovery like you saw in sales tax, but we are seeing growth in reported gross receipts. So, we're anticipating a mild growth year in gross receipts based business taxes. To the next slide, please. What you'll see and that might be worth focusing on when you're forecasting here is whether the concentration is specific, well, excuse me, whether the recovery is specific to certain sectors and if it's concentrated. We are seeing more of a recovery within the retail sector, similar to what Ken mentioned before. We are seeing certain sectors that are still fairly soft, and there is an impact if you've got caps built into your basic gross receipts tax. So watch for the impact of caps as well. This is based not on the taxes paid, but on the gross receipts reported. So this is showing that the businesses themselves are showing some growth in how much they are taking in for gross receipts. But as you can see on the next slide, there's actually a bit of a gap. It is closing, but there's a gap between the amounts there in the purple, which are the reported gross receipts, and then in the darker green, okay, we've got the actual revenue from gross receipts. And the gap we are looking at seems to be driven to a large extent by two factors: market consolidation, fewer businesses who then hit caps that are built into the gross receipts. So if you're taking up a lot of market demand, let's say you had 5 mom and pop grocery stores in your area and they kind of went out of business, and you've got a larger chain grocery store that took over and you've got a cap built in, there's not a decrease in the overall size of the market or the demand, but you're not going to see that revenue because the cap is not taxing those additional dollars that have now gone to the sort of winner takes all scenario. So those are some important factors for business license. Again, just on the next slide, very briefly, you can take a quick look, or when you get a copy of the slides, to kind of look at the overall trends, the year-over-year change between 2021 reporting and 2022, where it's concentrated based on NAICS sectors. So we're seeing a lot of growth in the arts and entertainment and recreation, transportation and warehousing, not surprising, again, what you saw from some of what Ken presented with fulfillment. So wholesale trade is another that's had some interesting growth as well. But then we've seen softening in some of the other areas here. So again, we're mildly optimistic. It looks like we've hit the bottom in terms of business license revenue and should see some mild growth this year. Some cities will see tremendous growth. We've seen that in some of our forecasts for clients in the spring. But overall, we're looking at pretty mild to flat growth in business license for this year. Now to turn to transient occupancy tax, to the next slide, please. We are seeing a rebound in the transient occupancy or hotel tax in cities that we help administer. We are seeing significant recovery from 2020, but still not back to pre-COVID levels. So if you take a look on the next slide with me, here we present a quote from kind of an industry thought leader. Again, the basic summary here is that we're trending positive, but there's going to be continued volatility, and the type of travel matters right now in terms of impacting your growth. So there's going to be growth of leisure and business leisure travel, but we're not expecting as much growth in strictly business travel. Zoom and other remote communication tools have, I think they're here to stay for a large chunk of business travel. At least that's what it looks like to us right now. So if we turn to the next slide, you can kind of see a regional look. The blue figures were the growth rates in gross rent year over year. So you're looking at 1920 in the blue. You saw very negative continued declines there. This year in each of the regions, you're seeing significant growth. And as you can see, vacation rentals, the second from the end on the right-hand side, vacation rentals are up 369%, really driving a lot of growth. So the growth seems to be focused in leisure and business leisure combined together. What we're seeing then also, we'll take a look at the next slide. You'll see some differences between the kind of stay. So again, we are seeing a good rebound in extended stays, but in regular stays, that's where we're really seeing it. So extended stay would often be driven, again, by long business trips. And so we would expect to see that be a little bit weaker than regular stay at this point in time, which is what we're seeing in the data as well. Now, the next slide takes us to look at what the sort of the hotel tier in terms of whether it's a small hotel based on revenue, a mid hotel based on average revenue, or a higher end hotel in terms of average revenue. And we're seeing a lot of growth at the lower end of the market and lower to mid market, but still significant growth in the high range as well. So across the board, but focused a little bit more on that low to mid tier range. What we're seeing also in terms of ADR on the next slide is that the industry is predicting that it's going to see a recovery to rates, average daily rates that are at or above where they were before COVID in 2023. So we'll get pretty close to getting back to pre-COVID average daily rates this year, and should see growth really beginning above the high water mark before COVID starting in 2023, again, driven primarily in the leisure and business leisure sectors. Now, in the next slide, we'll turn to short-term rentals. Now, in the short-term rentals, what we're looking at there is we think we've kind of, I wouldn't say we've hit the peak, but the growth is now starting to taper out and slow down. That's what the industry itself is expecting over the next 5 years. We are seeing growth just at a flatter rate, about 3 to 6% is what we're saying in 2022, and should see that kind of level off in the marketplace. In terms of forecasting on the next slide, a couple things to just pay attention to. Again, business travel is expected to remain below pandemic levels, pre-pandemic levels. Leisure travel should return to full this year. We're looking to see occupancy rates and room revenue again return to 2019 levels and then begin to grow into the next few years. So this year, you could see industry-wide year-over-year 15 to 20% growth, but again, that's going to be driven primarily in the leisure travel, less so in the business travel. And then for TOT specifically, it looks like the demand really is picking up as we look at what the industry in terms of average daily rate is seeing. Finally, some actions to consider with your hotel and short-term rentals. Again, many of which you're already doing, but continue to monitor, make sure you're looking at the growth rates. Look at providers potentially to help you monitor your TOT. Auditing may be called for coming out of this recovery and looking at the demand. Again, that'll be driven a lot by your insights as you monitor. You may need there may be an increased need for compliance. There may have been some loss of long-term knowledge. There was a lot of layoffs in the hotel industry early in the pandemic, and so there may be less knowledge about how to comply amongst some of the providers in your city. And then short-term rental compliance is needed. In this economy, homes are a key wealth-producing asset. More investment firms are entering this arena with short-term rentals. So you may want to consider taking a hard look at your short-term rentals and the compliance there as well. So I think with that, I will now hand it off to Sheila Poisson for her to present to us.
Good afternoon, everyone. My name is Sheila Poisson. I'm the Finance Director with the City of Torrance. Just a quick little bit myself. I've been in the finance field about 16 years now. Been with this city going on 6 years, but fairly new to the director role in this position for about 1.5 years. It's been quite a wild ride with the pandemic, as I'm sure it's been for all of you here on this webinar. Next slide, please. So where exactly is Torrance? Torrance we're in the southwest of Los Angeles County, the heart of what others here, locals here, call the South Bay, surrounded by cities such as Redondo Beach, Hermosa Beach, Carson, Gardena, Lomita. We're about 21 square miles large. A slice of that, part of the coastline, our population is about 145,000, and we are a full service city here with police, fire, public works, transit, community development, and community services, along with, of course, our administrative departments. Our citywide budget is $432 million, of which 240 or so is with the general fund, and we have about 1,500 employees. Next slide. Our top 3 revenues here in Torrance include sales tax, in order, property tax, and utility users tax. Being our largest revenue generator, we really rely heavily on sales tax as a source that funds our core operations. And as such, we rely heavily on HDL's data and forecast expertise to forecast our future. Next slide. This was really just thrown in here to give an idea of the mix of Torrance and why we value HDL's assistance so we can follow the trends in each of the industry groups here we have in our city. Next slide. The past 2 years for us, as I'm sure for many, have been extremely challenging in that we really didn't know what to expect in terms of recovery from the pandemic. We knew that first year that our sales tax would tank, and since it's our largest revenue source, we quickly pivoted to reduce our budget and hold vacancies, at least in that first year. We held vacancies for the last 2 years. However, that second year, we anticipated a much slower paced growth, the thought being that many wouldn't be comfortable coming back to the mall and in-person dining right away. So of course, we were pleasantly surprised when it was quite the opposite, and we were seeing 15 to 20% growth, double what we anticipated, but was in line with what the rest of the state was experiencing and even like our neighboring cities here in LA County. And that's also where HDL's information becomes valuable, is because when we go to City Council with our updates, we can tell them we're not really an outlier here. People were just ready and anxious to spend money. Next slide. I'd like to focus a little bit now on long-term forecasting. If you can skip to the next slide, and I'll come back to this one. Might make more sense to start here. In 2020, Torrance was placed number 4 on the state auditor's high-risk city dashboard, which ranks cities at risk of financial distress. This is obviously not a list we want to be recognized in, not something I want to advertise, but nonetheless, we do need to address. As you can imagine, lots of questions surfaced around how we got here. One of the major reasons, and easy enough to explain, was that our reserve balances were essentially depleted in 2020 with sales tax, that revenue source, almost turning off. Another reason I would say, however, was minimal focus on long-term forecasting. If we can go back to the previous slide, please. Thank you. The city historically focused on 2-year cycles. And because that was our budget cycle, 2-year operating, 5-year capital. Fortunately, for several years, it worked out. Our revenues came in where it needed to. However, with increasing costs and, of course, inflation, expenses eventually caught up and began to exceed our revenue growth. A good example to look at to stress the importance of long-term forecasting is the compounding effect of a modest salary increase. I point to salary because we're a full-service city, so of course, our largest line item in terms of expenditures is salary. It's our people. You can see here that a 2% increase appears to be and is manageable in the short term. But by year 10, it's costing $22 million. So this needs to be considered when we enter into multi-year employee contracts every 3 or 4 years, and those labor negotiations. Next, actually skip over 2 slides. We could. All right, so one of the actions Torrance is taking to address this is to propose a sales tax ballot measure. I'm obviously not here to pitch the measure, but I did include this slide as just an example. And this slide was taken from our community education efforts during the initial stages of education before the City Council approved to be placed on the ballot. One thing I did want to mention is that when we entered into this effort, we certainly weren't the only city, at least in LA County that we were watching, that had gone down this path. Over 60% of LA County cities have already gone down this path, with 8 out of 10 cities that have a population of over 100,000, which is kind of that range that we are in, City of Torrance, have already passed one as well. So in terms of the growth rate of expenditures exceeding the revenue growth rate, it's not unique to Torrance alone. So this effort, amongst others, if voters do approve it, should improve our status with the state auditor, should put us on a better financial footing. Hopefully one of these days we can be one of those success stories going forward. But again, this does, and at least I did want to express the importance of longer term, outside of the short term focus on forecasting, and how HDL and our other partners assist in that effort. That concludes my presentation. Just to thank you for having me here. And at this time, I'd like to turn it over to Lydia Romero, the City Manager of the City of Lemon Grove.
Thank you, Sheila. I get to wrap up this great presentation by our HDL partners. I will make it very fast because I do want to leave time so you all have questions to ask of the experts. First, a little bit about myself. My name is Lydia Romero. I'm a little different than my picture that was done about 6 years ago. I'm the city manager of the City of Lemon Grove, and I've been here for about 6 years as their city manager. And Lemon Grove is a small city in the east portion of San Diego County. We're about 27,000, and we're a full contract city. We contract for almost every single one of our services, our operational services that we have in the city. So unlike Torrance, using contracts, it helps us budget and plan in the future. So I kind of want to address why is forecasting helpful, and this is the Lemon Grove story. Is it sort of helps put our finances in perspective. When I first got here, we were doing 1 year budgeting, and we weren't looking ahead as to what our financial forecasting was. And so we started to do that. We looked at a 5-year forecast and the 7-year forecast for the City Council, and it helped us identify some issues with our general fund revenues and our general fund expenditures, and then trying to plan to meet the unmet needs of our residents. What our forecasting showed, based on our numbers that we got from both HDL on property tax and on sales tax, was we had some real issues with the diversification of our revenue stream. So for example, when I got here in 2016, our sales tax revenue was 43% of our overall general fund budget, with property tax and VL lieu and fees about 40%. So 83% of my budget is really 3 major funding sources, and one has the volatility of a marketplace. Today, we've tried to course correct that with some new revenue streams coming into town, some better forecast planning. We're at about 38% of sales tax for general fund, with property tax and VLF and lieu staying at about the same rate. And we know that our property tax will have see a blip in growth, but as Nicole mentioned, with our property tax, we know we're not going to see those bumps again for another 5 to 10 years, based on market turnover because of all the long-term holders of our property. What's going to be interesting is when we look at our commercial sector and what that turnover is for our commercial sector. We're starting to see some turnover with some of our commercial businesses, because some of the legacy property owners are starting to sell. And that will be interesting in the FY 24-25 year and beyond on what that looks like. So again, we used forecasting here to help us identify some of our problems, and then it gives the city council sort of a realistic look on how our budget is going to look in the future. If the council has an idea for employee salary increases or doing a class comp study, we're able to look at our forecasting numbers to see what we can and can't afford, how we can fit that in. And it allows us to better plan for downturns. So for example, when everybody hit with COVID, we looked at our numbers and we had already done some forecasting, so we knew what our numbers would look like. We were pleasantly surprised that our commercial base here in Lemon Grove really is what I call set up for a pandemic. We have a lot of quick serve, fast serve restaurants. We are not wholly dependent on malls or big businesses, and people were still buying cars. So, and doing a lot of home improvements. So we saw a lot of growth in those arenas, which helped keep our sales tax number high, which allowed us to get a larger share of the county pool, where we used to get a smaller share of the county pool. So I'm going to wrap myself up by saying, if you can, please do some forecasting on that one. It really will recognize your sort of fiscal health of your budget, and it will allow for longer term planning in the future, and it will help the policymakers. As a city manager, my job is to help my policymakers make the best decision that they can, and giving them some real honest numbers of what it looks like helps them plan in the future. And Melissa, I will turn that over to you. Melissa, you're muted.
Well, it wouldn't be a call in 2022 without somebody having to say, and you're muted. So I just want to say thank you to Lydia and to all of our presenters this afternoon. Some really great information that you all shared that hopefully will help as you all on the line go through your budgeting and forecasting processes. So we do still have some time for Q&A. So we've got a couple that have come in, but as a reminder to the folks on the line, if you do have a question, feel free to drop that into the questions box that you see on the right-hand side of your screen, and we will get to as many questions as we can in the next 5 to 10 minutes. So to kick us off, Ken, this is going back to your presentation, talking about sales tax, but can you speak a little bit to the breakdown of the increase in sales tax? How much of that is due to inflation versus actual growth in sales? Any thoughts there?
Yeah, thanks. I get that question a lot. Many folks, staff members come to me and say, hey, their council is wanting to know that. They're concerned that all the growth they're seeing is mostly just attributed to sales tax growth, or pardon me, inflation growth. But really, it is a chicken and the egg type of situation. It's impossible to really bifurcate the two. But I would say that strong demand coupled with limited supply is really what is driving inflation. And without that demand, there would be no inflation. So the Federal Reserve right now is working to punch that demand down by increasing the cost of money. And so that will ameliorate the problem over time. I think the key here in terms of messaging, if the city council is asking you a question like that, is to reassure them that in terms of the forecasting, you are including that in your thinking, that there will be a reduction in demand and inflation over time. And so that's taken into account when sales tax growth in forward years is decelerating.
Great, thank you. In a similar vein there, any projections or forecasting in terms of how long inflation will remain high, or as high as it is?
Yeah, so again, no one knows for sure, but I was looking at the results in that same Wall Street Journal survey that I referenced earlier about the possibility of a recession. And it looks like the bulk of economists are forecasting that by 2024, the middle of 2024, inflation will be only about 2%. But looking at the bond market, it's basically telling us that probably over the next 5 years, right now, the bond market thinks it's going to be closer to 3. So that's probably the best guess at this point. I think probably around 3%. I think it's clear that inflation is more durable and also will be longer lasting than anticipated just 6 months ago.
Great, thank you for your thoughts on that. Eric, a question going back to your presentation around TOT. Any thoughts on the breakdown between the increase that we're seeing in TOT, is that mostly related to an increase in average daily rates or an increase in visitation? Do you have any data or thoughts on the breakdown of those two things?
Yeah, I mean, the data that I'm presenting is driven primarily by that increase in average daily rates, right? So I'd be happy to take a look at that and get a little bit more data in follow-up on visitation. I will simply note that you wouldn't expect to see that large of growth in average daily rate unless there was demand pressure, right? So we are seeing some uptick in visitation, but yes, it's going to be influenced by inflation and other factors like wage price increases that are going to drive up that average daily rate to adjust for that in the market.
People getting excited to be able to travel again, right, and get on the road.
Again, in the leisure and the business leisure, that is where we are seeing, some increase in actual traveler and behavior. Looks like Ken, you might have something to add there as well.
Yeah, I just think it's very similar to the response to my question. Is basically without the demand, you wouldn't have the inflation, and so yeah. It's a chicken and the egg question. It's hard to bifurcate the two, but clearly demand is very strong right now for a lot of goods.
Great. Nicole, going back to your presentation, do have a question as it relates to property taxes. So you talked a little bit about development and the timeline and how all of that works together. But can you talk a little bit more about how long in the future it would take for folks to see that property tax revenue coming in for new large residential developments and things like that? So maybe just revisiting some of the timeline that you talked about at the beginning of your presentation.
Yeah, I mean, I think I tried for my presentation to oversimplify it a little bit for the purpose of the presentation. But I think, our advice usually is if there's no certificate of occupancy by October, you might not want to count on it because it's giving the assessor a shorter time frame between the certificate of occupancy and the close of the roll to be able to value something that might not be very typical, right? So if it's a 300 apartment building, 300 unit apartment building, it might take them a little bit longer to value something like that. So we normally tell our clients, if it's not certificate of occupancy by October, you might want to hold off and just, if it comes in, great. And if not, then at least you haven't, the last thing we want to have our clients do is over budget because it's a lot easier to adjust mid-year in a positive way than to adjust in a negative way.
Mm-hmm. Definitely. Always be a little pessimistic isn't the right word, but just be a little bit careful on those some of these. Conservative, yeah. On a kind of related question, we're talking about interest rates and the Fed and all of that. Any thoughts on how the increase in the interest rate that we saw today might affect housing prices, and or when we might see those effects?
If I knew that, I think I'd be rich. But I mean,
buying houses.
Yeah. But I think there's no question that it's going to impact the market and in turn property taxes in some way. Sort of kind of back to what Ken was saying, recession-wise or correction-wise, does it look more like a 2001 or more like a 2008? We sort of expect it to be more of we hope there's going to be more of a flattening with a decrease in volume and not so much this, kind of cliff like we fell off in 2008. And so, and the idea is that we're going to see it as it's happening. We're going to be able to warn, clients to say, okay, sales were off, X% and the volume's down. So, be prepared, so, but, ahead of time, no, I think maybe something by the end of 2022, we might start to see it work its way through. But that's 23, 24, right? So that's sort of my best thought on that.
If only we had a crystal ball, right? Then we'd all know when to buy houses or or sell, right? Okay, it looks like we've got one final question we might have time for quickly. The question is VLF normally included with property tax revenue in the budget, or are they forecasted the same as property taxes?
I've seen it both ways. I would advise having it be a separate category. So it grows by a different rate unless you're a city without a successor agency. And if you start to see something not come in as expected and you've kind of lumped it all together in one category, if I'm understanding your question, then it's harder to see where the variance is, right? So did BLF not come in, or did regular revenue not come in? Where's the what's not adding up? So yeah, I would always, the more categories for me, the better. Yeah.
Right. Perfect. Okay. That looks like all of the questions we've got so far, and we are right out of time. So great timing in that regard. Just want to quickly share some ways to stay in contact with ILG. We've got a number of other trainings coming up around equity, around ballot measures and elections, around wildfire preparedness, a whole host of different topics. So if you're interested in more information from us, definitely connect with us on social media and sign up for our newsletter. And then I'm going to go ahead and put everybody's contact information up here in case you have a question offline, or you didn't have time to get it into the chat while we were still in the Q&A portion. So want to get everybody's contact information up there so you can follow up as needed. And as I mentioned earlier, we'll definitely make sure to get the slide deck and the recording out to all of you on the line so that you can revisit some of those graphs and trends and information that we went through pretty quickly this afternoon. So hopefully you can have that in front of you and make that a little bit easier to reference. And with that, just want to open it up to any of our panelists that might have any closing thoughts or anything else they want to share before we close out this afternoon.
Just thank you, Lydia and Sheila, for joining us today.
Absolutely. Just a thank you from the City of Torrance as well for having us. Happy to provide any sort of feedback for any future if you need.
And Lemon Grove is happy to be the juxtaposed small city with the big city of Torrance. So yes. And you are our extension of staff, both Ken and Nicole. So thank you.
Perfect. Well, I definitely want to echo that thank you to all of the panelists on the line for sharing your information, for sharing your experiences, for sharing your afternoon with us. And so with that, I'm going to go ahead and thank the attendees on the line as well and close out for the afternoon. So have a great afternoon, everybody, and hope to connect with you all again in the future.
Thank you.